December 3, 2025, four major South Korean banking institutions made an announcement that sent shockwaves through precious metals markets worldwide. They would no longer be selling physical silver to customers. Not temporarily. Not due to supply chain disruptions. Indefinitely. These weren't small regional banks struggling with inventory issues. These were massive financial institutions with global reach and unlimited capital access. If they can't source silver, what does that tell you about what's really happening behind the scenes? Right now, something extraordinary is unfolding in silver markets that most people aren't paying attention to. While everyone's focused on stocks and cryptocurrency headlines, a fundamental shift is occurring that could reshape how we think about money, wealth preservation, and financial security. The signs are everywhere if you know where to look. Spot silver prices are trading above futures contracts, a phenomenon called backwardation that signals extreme physical demand. Major banking institutions across multiple countries are restricting precious metal sales. We're not just looking at another bull market in precious metals. We're rewatching the early stages of what could become one of the most significant wealth transfers in modern history. And the window to position yourself advantageously is narrowing faster than most people realize. Let me walk you through what's actually happening right now and why understanding these developments could be crucial for your financial future. Because the story unfolding in silver markets isn't just about one commodity experiencing price volatility. The infrastructure powering our digital economy, from data centers to communication networks, depends heavily on silver's unique properties. Now consider the supply side of this equation. Global silver mining production has been declining since 2016, despite increasing demand from multiple sectors. The numbers are startling when you examine them closely. Industrial consumption alone accounts for approximately 60% of total silver demand, and that percentage keeps growing as technology advances and green energy initiatives expand globally. When institutional investors and industrial users simultaneously seek physical delivery, the mathematical realities of supply and demand assert themselves regardless of paper contract obligations. Historical precedents suggest that markets experiencing similar dynamics eventually reach inflection points where paper pricing mechanisms lose effectiveness. We've witnessed this pattern in other commodities during periods of extreme supply constraint. The question isn't whether such dynamics can persist indefinitely, but rather how long current arrangements can accommodate growing physical demand against declining available inventory. Exchange data from major trading venues shows registered silver inventories have declined dramatically over recent months. These aren't normal fluctuations based on seasonal patterns or typical commercial activity. The withdrawal rates and volumes suggest institutional-level repositioning that goes far beyond routine profit-taking or portfolio adjustments. Industrial demand continues growing based on technological trends that show no signs of reversing. Monetary demand reflects broader concerns about fiscal sustainability and currency stability that extend far beyond silver markets specifically. What happens next depends largely on how quickly these dynamics accelerate and whether current market structures can accommodate the resulting pressures. But the trajectory appears increasingly clear to anyone willing to examine the available evidence objectively. When major financial institutions with sophisticated supply chains and global relationships simultaneously step back from physical silver sales, it suggests underlying structural issues that aren't immediately visible in published price data. Consider the mathematics of current market positioning. Exchange data shows that total silver futures contracts represent claims on approximately 800 million ounces of metal. Physical inventory available for delivery against these contracts sits at roughly 43 million ounces. That's a leverage ratio of nearly 20 to 1. Under normal market conditions, most contracts settle in cash rather than physical delivery, allowing the system to function smoothly for decades. But what happens when that assumption breaks down? When industrial users, institutional investors, and retail buyers simultaneously demand physical metal instead of cash settlements, the arithmetic becomes problematic very quickly. There simply aren't enough ounces in exchange vaults to satisfy delivery demands if even a fraction of contract holders insist on taking possession. This scenario isn't theoretical speculation. We're watching it unfold in real time through withdrawal data from major exchanges. Since October, registered silver inventories have declined by over 37 million ounces. That's not gradual profit-taking or seasonal adjustment. That's institutional-scale repositioning happening at unprecedented velocity. The solar panel industry alone consumes approximately 200 million ounces annually, and that number grows every year as renewable energy installations accelerate globally. Electric vehicle production requires roughly 3 times more silver per unit than traditional gasoline vehicles. Data center expansion for artificial intelligence and cloud computing creates additional industrial demand that didn't exist 5 years ago. Meanwhile, mining production continues declining despite higher prices that should theoretically incentivize increased extraction. The reality of silver mining is that most production comes as a byproduct of base metal operations. You can't simply decide to mine more silver without corresponding increases in copper, zinc, and lead extraction. Those markets operate on different cycles with different economic drivers. This supply-demand imbalance has been building for years, masked by the efficiency of paper markets that created the illusion of abundant availability. But physical realities eventually assert themselves regardless of financial engineering. When major industrial users need actual metal for production lines, paper contracts become inadequate substitutes. The Hunt brothers situation from 1980 provides instructive parallels, but also important differences. Nelson and William Hunt accumulated massive positions using futures contracts and leverage. When exchanges changed margin requirements and trading rules, their positions became unsustainable and they were forced into devastating liquidations. Today's dynamic involves different players with different motivations. Industrial users need silver for manufacturing processes that can't be postponed or substituted easily. Sovereign wealth funds and central banks view precious metals as strategic reserves rather than speculative trades. Retail investors in multiple countries are seeking wealth preservation tools as confidence in fiat currencies erodes. This broader participation base makes the current situation potentially more volatile, but also more difficult for exchanges to control through rule changes. You can modify margin requirements for speculative traders, but you can't force solar panel manufacturers to stop needing silver for their production processes. The breakdown in traditional market mechanisms becomes visible through pricing anomalies that shouldn't exist under normal conditions. Physical dealers report paying significant premiums above spot prices just to source inventory. Some are quoting delivery timeframes measured in months rather than days or weeks. Online precious metals retailers show persistent out-of-stock notices for popular silver products. These aren't temporary disruptions caused by shipping delays or seasonal demand patterns. They reflect fundamental misalignment between paper pricing mechanisms and physical market realities. When the two diverge significantly, the physical market ultimately determines true value regardless of what futures contracts suggest. Recent geopolitical developments add another layer of complexity to these dynamics. Russia has been effectively excluded from London precious metals trading following sanctions implementation. China continues restricting precious metals access for citizens while simultaneously accumulating strategic reserves. India maintains record-level imports despite elevated prices. Each of these developments represents sovereign nations prioritizing physical precious metals accumulation over participation in traditional Western financial markets. When major economies begin hoarding strategic commodities, it signals preparation for monetary system changes that haven't been publicly announced. The currency implications extend far beyond precious metals markets specifically. Central banks globally have been accumulating gold reserves at unprecedented rates. The dollar's share of global foreign exchange reserves has declined steadily from over 70% to approximately 58%. Alternative payment systems developed by BRICS nations are gaining traction for international trade settlement. These trends suggest broader monetary system evolution that could accelerate rapidly under the right catalytic conditions. Physical silver, with its dual role as industrial necessity and monetary metal, sits at the intersection of technological advancement and monetary uncertainty. Market participants who recognize these patterns early have historically benefited from positioning ahead of mainstream awareness. Those who wait for confirmation through mainstream financial media typically find themselves paying significantly higher prices for the same assets. The window for acquiring physical silver at current premiums and availability levels appears to be narrowing. Not because of artificial scarcity or market manipulation, but because fundamental supply and demand dynamics are reaching inflection points that have been building for years. What comes next depends largely on how quickly these pressures escalate and whether current market structures can accommodate the resulting stress. But the trajectory seems increasingly apparent to anyone examining the available evidence objectively. The patterns are clear, the data is undeniable, and the window is closing faster than most people realize. What we're witnessing isn't just another commodity cycle or temporary market disruption. This is a fundamental shift in how physical silver markets operate, and the implications extend far beyond precious metals specifically. When major banking institutions across multiple countries simultaneously restrict physical silver sales, when exchange inventories drain at unprecedented rates, when backwardation signals desperate physical demand, the message becomes impossible to ignore. The paper promises that have dominated silver pricing for decades are colliding with physical realities that do, and care about financial engineering or regulatory interventions. The mathematics are straightforward. Industrial demand continues growing based on technological trends that show no signs of reversing. Supply constraints reflect geological and economic realities that can't be solved quickly or easily. And monetary demand reflects broader concerns about fiscal sustainability that extend far beyond any single commodity market. Those who understand these dynamics and position accordingly may find themselves on the right side of one of the most significant wealth transfers in modern history. Those who wait for mainstream confirmation or government assurance may discover that the opportunity has already passed. The choice is yours, but the clock is ticking. Physical silver remains available today at premiums that may seem expensive in hindsight. Tomorrow, availability itself may become the primary constraint regardless of price. If you found this analysis valuable, make sure to subscribe because what's happening in silver markets is just one symptom of much larger systemic changes unfolding across global financial markets. The next video will explore exactly where these trends are heading and what it means for your financial future.